Thank you, Rodrigo. Excellent analytical bit of enlightenment there. I'm sure you'll all agree. I'm going to continue the theme in terms of analysis of the coal market. I was asked a question by Coaltrans for my presentation: will high coal prices continue into 2018? I'm not one for giving outright price forecasts. I think it's a bit of a fool's game, but hopefully I'll kind of set a bit of a scene in terms of where we are now, and hopefully give a bit of a view in terms of the fundamentals going forward over the short to medium term. So just first up, a quick bit about my company, Argus Media. We're a price reporting agency. We publish news, analysis, benchmark prices across a variety of markets. I'm proud to say coal is one of our mainstays. We jointly publish the API indices, which I'm sure many of you will be familiar with our joint venture partners IHS. We also publish the ICI indices, ICIs 1, 2, 3, 4 and 5, which focus on the Indonesian market with our joint venture partners Coal Indo, based in Jakarta. In terms of the APIs, around 90% of coal derivatives settle against one or more of these. The ICIs, acronym for the Indonesian Coal Indexes, they've become really the established benchmark as the principal point for trade in Indonesia. I'm exploring, along with a number of colleagues in the audience, the potential for a derivatives market around the ICI. There we go. As I'm sure you'll agree, given the price volatility in the recent past, this is becoming more and more prescient. We also publish a monthly seaborne thermal coal outlook. I think you should all have a copy of that as well. Provides in-depth and forward-looking analysis and forecasts of demand, supply, and some of our key price benchmarks as well. So just a quick look back on 2016. Hopefully on this map you can see there's quite a lot of data on it, but I'll just kind of draw your attention to one or two things. So in terms of Europe, we saw a big reduction. In terms of Southeast Asia, we saw a big increase of 15 million tonnes. In China, as Rodrigo's gone into quite a lot of detail on, we saw an increase of around about 38 million tonnes, and Indonesian supply coming into the market at quite a high rate. Quick look back in time, 2015 was a pretty catastrophic year for the coal market there. It was probably the first time in living memory that we saw a reduction in the overall seaborne market size, and it was quite a significant reduction as well. But we have started to grow again. Obviously 2016 was a bit of a bumper year, and my expectation is it will continue to grow into the near future. So in order to answer the question, with a forward-looking view of where we're going to go, it's probably worth reflecting on where we are now. As a result of a massive influx of supply over the past, between 2012 and 2016 really, we saw prices across pretty much every key benchmark drop down to 13 to 15-year lows at the beginning of 2016, and then we saw this kind of big rally towards the end of last year. Things have eased off a little bit. We're seeing a lot of volatility in prices, but I think that where we stand now, we are kind of looking a little bit overweight. So how did we get here? Really, as Rodrigo alluded to, the demand improvement has been larger than expected. Although outside of China, demand fell across the board in 2016. There was some strength in Northeast Asia and Europe during the winter of 2016, but really it was the recovery in Chinese imports that drove things forward, particularly with a pickup in power demand and industrial activity in China. But this led to a reaction from seaborne suppliers. Export supply has grown by 7% year on year in the past 6 months. Marginal supply from the US and Russia are increasingly driving growth as weather and logistics have been disrupting Indonesian and Australian output. I'd like to bring your attention to this part of the chart here. The orange bars are essentially US and Russian incremental output year on year. And you can see that of the 7% year on year growth that I mentioned over the past 6 months, really that's been dominated by marginal supply coming in from the US and Russia. So suppliers have been reacting to the price surge. In terms of the change in that Rodrigo alluded to, and I'm sure you're all a lot more familiar than me with. The workday restrictions eased in September, but the recovery in production in China domestically has been relatively slow. So output in Shanxi and Inner Mongolia is now growing quite strongly, but in Shanxi we're actually still seeing a contraction in March 2017, year on year, this part of the chart here. So what's next in China? Chinese stocks remain relatively low. Domestic supply will continue to improve. There's obviously the price incentive. There's the government incentive as well, which is very, very strong. Inventory declined in early 2017 as demand remained stronger than expected. But the incentives to increase output are high, and the government is unlikely to interfere given the recent price strength. So far, the output-related restrictions have been reactive to past trends and not necessarily forward-looking. And there are some serious downside risks from Chinese power demand in terms of coal-fired generation. So my estimate is that power demand growth of 3% plus is probably needed to sustain coal burn, the coal burn growth that we saw last year. There's some anomalies in the data that I've been looking at given the hydro situation in China last year. But really, you can see that there are some risks. So I'd like to highlight on the chart here that this incremental growth in thermal power supply in China was really dominated by thermal. And then if you look on the bottom chart here, you can see this is the Shanghai interbank rate, which is, you can see interest rates in China are growing. This is crude steel output in China, which is a relatively good bellwether for economic performance in China, particularly in the industrial sector. And you can see it's flatlining. In terms of where that leaves us for arbitrage price and volume risk. So a weaker Chinese domestic price should translate into lower seaborne markets. We've seen a very clear correlation over the past 10 years or so since China really came into the market as a big net importer of lower Chinese prices leading to lower seaborne prices and vice versa as well. But I'd say imports don't necessarily have to fall for prices to weaken. They're likely to be displaced by domestic coastal shipments. We've seen around about 25 million tons incremental year-on-year coastal shipments in China. That's kind of domestic supply. But we're talking about relatively small numbers in the grand scheme of the Chinese market. To shift the focus away from China a little bit now and look at India. So power generation has been low and weakening year on year at coal-fired power plants in India that are dedicated import plants. We've seen a 3% reduction year on year in Indian IPP generation. That's a direct result of a number of factors really, but there's been very high Coal India pit head stocks. Obviously, the government drive to improve and increase production domestically has been bearing some fruit in India. Petcoke has also been displacing imported coal in the cement sector. So I think there was an increase of around 4 to 5 million tons of petcoke last year, and this is displacing somewhere in the region of 8 million tons of thermal coal. However, it's worth saying that the regional demand weakness that's been led by India in South Asia has been mitigated somewhat by stronger Pakistani imports. In Pakistan, there's new power plants coming to market now, and the infrastructure to match ports, railways, and so on. So there's a bit of a bright spot in South Asia there. In terms of Northeast Asia, so one phenomenon that we saw last year, which took a lot of us by surprise really, was how weaker European demand pushed more coal into Northeast Asia. There was a very soft coal-fired generation in Europe throughout most of last year, up until about winter time. You can see on this chart here, there's a steady, quite a sharp drop-off actually in European coal burn in the middle of throughout last year. So this obviously translated into weaker API2 markets, API2 being the Northwest European delivered price. And this supported an arbitrage of Colombian and to a lesser extent South African tons moving into Northeast Asia. We also saw high prices dragging US West Coast supply into the region. So on the chart here, you can see essentially a very, very sharp increase in Colombian, South African, US West Coast supply into Northeast Asia from practically zero at the start of last year to very high, touching 3 million tons across those three suppliers. I mentioned the demand risks in China, with relative, the potential for a bit of a slowdown in industrial demand. But those demand risks do spread beyond China in the region. So we saw new generation capacity in Korea coming on stream. This represents long-lasting demand growth, and this fed into some of the increases in demand that we saw last year. But there was, a lot of the recent rush was driven by nuclear outages related to the earthquake in Korea in September, and some maintenance along with low inventory. So where we saw at the start of this year 30% year-on-year increase in Korean demand, probably more than half of that is related to kind of one-off factors. In terms of Southeast Asian demand, I think I mentioned earlier in the presentation, this is a bit of a bright spot. Imports have continued to rise into 2017 after a very strong 2016. There are signs of sensitivity to high prices, but most of the incremental demand is structural. This is down to new plants being built quite quickly in Thailand, Philippines, and Vietnam. This will support growth in demand going forward. But I mentioned price sensitivity. So here on the chart you can see, obviously this is the point in time where prices spiked, and the immediate reaction was much lower imports from those three countries. However, as prices have dropped, there is a kind of inversion of correlation there, where you can see imports have started to increase again, back up to nearly all-time high levels. So I'll ask the question now: is what we've seen and what we've kind of laid out going forward, is this enough to support the recent supply growth? So demand in 2017 and 18, by my forecast, is set to grow, but only moderately, really. What would be the right price level to find a balance in here? We've seen a long period of time, 2015, early 2016, where I've put on here that prices were too cold, as in supply was being destroyed at quite a rapid rate. And then we've seen a period in 2016 where prices get too hot, and we just see this kind of this big influx of additional incremental year-on-year supply coming into the market. This time last year, the price was too low, the supply was destroyed, but the recent prices are creating strong supply growth that is likely to continue. So I'd argue that until we see a bigger correction in prices, essentially that supply growth will continue. The logic behind that being that, obviously, I think prices are probably going to move down in the short to medium term. That brings me to the end of my presentation. Thank you for your time. I'll take any questions.